Hey, and welcome to another video here at Fiscal Voyage. And in this video, we're going to do a stock analysis on Ventas Inc., ticker symbol VTR. This company was suggested by Dimitri. Thank you, Dimitri, for suggesting this company and for watching a previous video and commenting as well. So with this stock analysis, we're going to determine a fair value price for this company, and as well, I'm going to provide you with my recommendation if either is buy, hold, or sell, and that's towards the end of this video. So if this is the first time coming to my channel, make sure to hit that subscribe button because I like to do stock analysis videos such as this one of different companies and companies that you guys suggest. All right, the stock analysis on Ventas Inc., ticker symbol VTR. A little bit about the company. It's a real estate investment trust. So we look at funds from operation and free cash flow during this and analyze. So first off, the company specializes in ownership and management of healthcare facilities in the United States, Canada, and UK. And as of December 2019, the group portfolio consisted of 1,200 properties divided among nursing homes, medical office building, rehabilitation, acute care centers, special care centers, laboratories and research centers, and medical surgical centers. So let's look at the fundamentals for VTR. The company revenue grew at 15.9% in the 10-year period from 2010 to 2019, so that's real good. Nice revenue growth. Net income also grew at a nice rate of 6.5% for that 10-year period, and currently the company has investment grade BBB+, so that's positive there. And operating income at 7.8% in this 10-year period. However, for the past 5 years, the company has been slowing down. First, let's look at funds from operation. Since it's a REIT, we look at funds from operation instead of earnings per share. So funds from operation per share growth for the 10-year period is 5.7%. But like I was saying, the 5-year average for revenue, net income, and funds from operation has decreased drastically. For example, the 5-year average revenue grew at 4.13% versus the 15% for the 10-year period, and net income at 0.89%, and funds from operation at only 0.5%. So actually, the past 2 years, earnings from funds from operation were decreasing even pre the pandemic. So let's continue with the fundamentals as well. 2019, the company had adjusted earnings or funds from operation of $3.85. Net margin came in at 11.2%. Return on equity 6.6%. That's the average over the past 5 years. So that's they're consistent in that aspect. The current dividend at 5.16, and we're going to talk about this shortly. And the 5-year dividend growth rate is null because the company actually cut the dividend. They cut it by 43% in June 19. So that's something concerning because the funds from operations is expected to be lower than the dividend. So that's why they cut the dividend for this year. However, the dividend payout ratio at the current dividend and the current expected funds from operation for 2020 is only 57%, so that's positive there. So it doesn't look like the company is likely to cut its current dividend, so that's positive there. But if you own shares prior to this, it looks like you lost some money here. Therefore, of course, with the dividend cut, the company years of dividend growth went to zero. They had a nice dividend growth record prior to this, but right now, because the dividend cut of 43%, now we're back to zero, so they have to start new. The 5-year dividend average is 5.21, so the current yield is basically right at the 5-year average, slightly lower, but again, the dividend looks to be safe at currently. So let's continue. The balance sheet, debt to cap only 56%, the current ratio at 2.59, so that's very positive there. Debt to equity at only 1.36, that's fairly better than a lot of the other investment REITs or healthcare REITs. Interest coverage at 2.27, that's fairly low. And price to book at 1.22 versus the 5-year average of 2.05. That means it's a good indicator that the company may be undervalued. And here's something to note also, just because the balance sheet was actually pretty good for this company, but because funds from operation were to be lower for this year, you see the dividend cut. So Just FYI. So even though a company has a good balance sheet, doesn't mean they won't cut the dividend. So 2020 future outlook. As you can see here, funds from operation comes in at $3.16, which is again lower than the 2019 fund from operation of $3.85. So they're expected to lose, money through this pandemic and the economic shutdown, which is strange because the company focuses on healthcare for most of their properties. So that's some interesting. But again, even before the pandemic, they were losing money for 2 consecutive years, and they were flat the prior years after that. 2021, they're expected to be higher at $3.23. So they're expected to grow going forward from here. CFRA has a projected funds from operation growth of 2%, and my dividend yield return model projected total return at 8.2%. So it's lower than my criteria, 9% or higher. So that's a concern there. Forward price to funds from operation is 11.2, and the 5-year average at 14.9. So if we look at the fast graph for the company, as you can see here, the blue line represents a 15 PE basically, and the orange line is a funds from operation with a 10.5 PE, or P to funds from operation, but we use PE because it's easier to say. But I actually use a valuation of a 12 because I highly doubt the company will go back to a 15 multiple. So I think a 12 multiple to funds from operation is more reasonable currently, of course, with the dividend cut and such. And as you can see, from 2016 to 2019, 2016 had a nice earnings growth of 10%, but 2017 it was basically flat at 1% growth, but then it dropped 2% in 2018, and 2019 it dropped 5%. So they were having some issues with growing earnings or funds from operation for the past 2 years, and of course the economic shutdown didn't help out either. As you can see, however, the blended FFO yield is 9.98, which is very attractive. Of course, most of this is from the dividend yield at 5.16, and the expected earnings or funds from operation growth going forward. So there's potential to make money at currently prices, but we'll talk about that shortly, as the fair price for the company tells a different story. CFRA has a fair price of $32, Morningstar $50. Fast Grabs, we saw $37. This is based on the 12 multiple, and Yahoo at $33.65. My dividend discount model analysis at $26.23. I use a 2% dividend growth for the next 3 years and 2% after that, with a discount rate of 9% because the dividend is quite high. But even then, my dividend drill return model came in at $26.23. Averaging out the 5, we get a fair price of $35.96. Currently, the company goes for $35.45. So it's basically fairly valued at current prices. It's slightly undervalued at 1.4%. And that's why I have a hold recommendation for this company. So as you saw, I have a hold recommendation for this company, and the reason for the hold is because they recently had the dividend cut. And I'm a dividend growth investor. I don't like companies that cut dividends, and so I think that's why the company is a hold right now. I'll wait for a few quarters to see if there's some growth, as because the past 2 years their earnings were going down slightly, but the economic shutdown didn't help. And I see healthcare facility and properties continue to grow, of course, with the baby boomers and people getting older and living longer. So there's definitely potential for this company to make a lot of money for you. But right now, I'll wait for it to pass a few quarters to see, read the reports and see how it's going. With the recent dividend cut, I think the company dividend is safe now because the payout ratio is very nice in both funds from operation as well as the free cash flow. Like I said, it's a healthcare REIT, so the future potential is quite nice in the sense that 5 years from now, 10 years from now, I see this company to be much more higher than what it is now. But currently, I think there's better investments at today's environment. But this one should be definitely in your watch list. But also make sure to read some of the earnings report before you think about investing in this one. But thanks again for watching. And again, if it's your first time visiting the channel, make sure to hit the subscribe button. And let me know what you think of the video in the comments below, as well as let me know other companies you would like to see next of me to analyze next. So I'll see you guys in the next one.